ICICIdirect. We're in an exclusive conversation with our guest who's joining us today, Mr. Vikram Dhawan, Head Commodities and Fund Manager at Nippon India Mutual Fund. Vikram has over 20 years of experience in global commodity markets. Thank you, Vikram, for joining us on the show today. Vikram, you've seen more than 2 decades of cycles, if I must say, especially with the way the buying and selling has been in the commodity market. Gold specifically has been in the red on a yearly basis, even though the last 2 months saw record numbers for gold ETF. In your opinion, while risk is doing well, so global equity markets have been on the rally, why is gold underperforming?
So first of all, thank you very much for inviting me on your show. With regards to gold, obviously, like other asset classes, it moves in cycles. And the current bull cycle started actually in 2016-17 when gold bottomed out at about $1,000 per ounce. And since then, it has been a one-way move. But yes, we have seen some deep corrections on the way also. 20, 30, 40% corrections. And most of the corrections were actually driven by, the onset of pandemic. So typically what happens is when the liquidity dries up in any global crisis, whether it was 2001 or 2008 or 2020, even gold also gets sold, because if you cannot sell your equities and bond portfolios, then you have to, depend upon, and that's why people buy gold, isn't it? When, the last resort, the hedge of last resort. So we saw at the onset of pandemic, gold getting sold off. And then obviously we saw a lot of portfolio diversification and hedging sort of inflows into gold, record inflows. I mean, at one time, the inflows over the pandemic period was close to about 1,000 tons in the ETFs. So that was where we were as far as the pandemic is concerned. But I think what really happened was that whether it was the bond market or equity markets or commodity markets, most sort of miscalculated the quantum of the risk which this pandemic will bring. And whilst there was a very massive inflows into the risk hedges like the treasuries and gold, etc., and currencies like the yen and the Swiss franc. There was an equal violent outflow when people sort of had a handle on what kind of risks we are talking about and what kind of economic cycle where we are right now. So this has been the topsy-turvy story of gold, where the inflows and outflows have continued. Globally, we have seen the ETFs flows or the investment flows to be a mixed bag. While we have seen North America being, net outflows from North American ETFs, but as far as the investments through bars and coins are concerned, they are at all-time high in North America and of course in Europe and Australia and Oceania as well. What has also happened is that the central banks are back buying. Last year they could not buy because everybody wanted every millimeter of their balance sheet to be used to leverage, the liquidity to ensure there is a stability in the capital markets. So yeah, so this is as far as the reason why we have seen gold underperforming in the past 1 year, when these sort of people are resetting their expectations on the quantum of the risk. But having said that, if you look at the performance of, I can only talk about our funds, Nippon India Gold ETF, which was launched in 2007. The returns since inceptions are in, and I'm talking about CAGR returns, are in excess of 10% per annum. If you look at the past 3-year returns, they are in excess of 14%. So whilst gold has been volatile, the historic returns have been fairly steady. Obviously, it's a different asset class in itself. It is not comparable to bond returns or equity returns. So yeah, so that's where we are as far as gold is concerned.
Right. Vikram, gold is correlated directly with the dollar yields and, of course, inflation, right? Internationally, gold prices have been in focus once again in the last couple of weeks as concerns over inflation are rising. Manufacturing data coming out from the US is low, the dollar and yields are also retreating. And locally, of course, better than expected economic growth, pent up demand, and low prices is really what's been driving gold prices, I'd imagine. Nippon, specifically in September, has also added zero point 0.5 tons or about $31 million worth of gold in your Nippon India ETF gold piece. What do you think the reason for this is? What is the rationale? What has changed in the month of September?
So I think the the investors who have had, a sort of a longer horizon, in longer investment horizon, or who have had an experience of past 10, 20 years where they have seen the 2008, the dot-com and the 2008 economic crisis, they very well have experienced firsthand how gold bailed out their portfolio when everything was down. So there is a history which is still pretty much which is very well accounted by various investors who have been investing for the past 10, 20, 30 years. And typically what happens is that since gold is a longer term story, it's more of a diversification and a hedging story, not so much a tactical play, then
Mm-hmm.
many of the canny investors would actually make use of the volatility by either buying the dips or by going through an SIP route. So we have a gold savings fund which offers you an SIP into gold. So if you don't have a view, short-term view or a medium-term view on gold, you can always do an SIP. Obviously, uh, with the proviso that you are who believes in the diversification and hedging, attributes of gold. So we have seen those flows continue, and they have been pretty steady. And in fact, we were also surprised that whilst all the press was negative, the macros were negative, but still people have, the investors have shown faith in the asset class.
Right. Vikram, I want to talk to you about going ahead, right? What do you think are the factors that are working in favor of gold and against it? There are some reports out there that are indicating that gold is probably the most undervalued amongst the financial asset categories. And there is a general belief that we might see it to shoot up to new lifetime highs by as early as the end of this year. The dollar weakness, no sign of increase in interest rates, pent up demand, like I said, festival season around in India. Do you think there is a likelihood that gold could breach its previous lifetime high of 56,191
So
rupees?
I'll also answer the part of the previous question also, which I did not answer. So with
Mhm.
regards to its correlation with the dollar, interest rates, equity markets, and other risk parameters like credit spreads and all, yeah, the gold does react to the macro parameters. Now, with regards to dollar, we have to be very careful. If you look at the long-term correlation, it's extremely negative. It's negatively correlated, and the correlation is pretty high. It's beyond 60-70%. So anything which is more than 50% negatively correlated is can be used, in a hedging or a diversification strategy. But if you look at the correlation between gold and dollar in the short term, in the past few months and few quarters, actually it's zero or slightly positive. So, whilst macros will play out over a longer period of time, but
Right.
in the shorter to medium term, they can be very confusing. Similarly, for interest rates and inflation also. So typically what happens is the interest rate cycles tend to be ahead or behind the commodity cycles, because I'm assuming that when the economies bounce back, the commodity prices would bounce back either earlier or later. But obviously, in our case, what has happened is, commodities have bounced back a lot earlier than the economic numbers started, and so did the equity markets also. So that typically gives a tailwind to gold because it's a hard asset at the end of the day. Whilst you can call it a currency or a hedge, but it is also a hard asset. It tends to give tailwinds in the medium to short term. But over a longer period of time, if the interest rates, especially the real interest rates, are going to be going a lot higher than the market expects, then it is a very significant headwind for the gold. But again, that is where lies the catch. With regards to, obviously, interest rates will react to take care of the inflation. Now, gold's relationship with inflation is pretty complex. It's not straightforward. If the inflation is within the expected bands, suppose, let's say US is talking about 2%, we are talking about 5%, 6%. So if we are flipping around plus minus 1% of that or 0.5% of that, it'll have no bearing on gold, positive or negative. But if we overshoot or undershoot this band, then gold will react, because then that is the shortest, least path of resistance to hedge your inflation risk. Obviously, you have to understand gold is as liquid. One of the reasons why the central banks and investors and institutions like gold is because the liquidity in gold is almost same as what you would find in an S&P 500 index or an Dow Jones index. So the getting in and getting out large monies is very easy, which you cannot do, let's say, in a copper or oil or coal or steel, which you cannot do. So yes, the macros do play a part. Also, again, to very good point you mentioned regarding gold's relative value against various asset classes. Now, if you compare them to equities, with regards to Nifty, we are, I think, some 16, 17 year the ratio of gold versus Nifty is about 16. It's actually an all-time high, all-time low against gold.
Right.
If you plot it in dollar terms with S&P 500, it's almost a 16, 17% high. If you take away the blip of 2007, 8, and 9 of gold and equity prices, it is also an all-time low. Gold ratio against S&P 500. Gold's ratio against oil is at historic low. Gold ratio against copper is at historic low. So yes, gold has been a gross underperformer against most of these risk assets. When the mean reversion takes, it's very difficult to say, but yes, it's just a matter of time. I mean, we believe that we are living in a universe which reverts in the mean reverts. So if you believe in that, then it is just a question of when. But again, here is a warning that the central banks can keep this market flush with liquidity long enough for us to get test our patience in any asset class. So you have to take a very long-term view. It can happen tomorrow, it can happen next year, we don't know. But yes, the mean reversion does take place if history is to be relied upon.
And hence the recommendation of staggered buying, right? Though the movement of gold may not be linear amid the risk-on sentiment in the markets, I think accumulating gold in a staggered manner is probably the best advice viewers can pick up from our conversation. You talked about the correlation between gold and inflation. If you can just elaborate a little bit more, Vikram, about how gold becomes an inflation hedge and what does that really mean in layman terms?
So what happens is that the inflation in a country, again, it is very specific. So one of the reasons why gold has not rallied so much against dollar is because the inflation in the US historically has been a lot lower than, let's say, inflation in India or Turkey or maybe Euro region and all. So it's a function of what is the inflation and what is inflation actually. Inflation is actually, if you really want to understand inflation in commodity terms, it is the flow, it's the supply of the currency increasing vis-a-vis the hard assets. So and that is what has happened during this pandemic. We used to call Mr. Ben Bernanke the man with the helicopter who used to drop money on the helicopter. I think we have gone way beyond that now. We are talking about super tankers of money being pumped around and pushed around in the world. So if you understand inflation in such a way that too much money chasing too little assets, and that what it does is that it favors the hard assets, because beyond a certain point of time, the financial assets will start looking expensive because there are a lot of technicalities involved in that. But in case of hard assets, I mean, we have all seen in real estate, anybody who invested in a house in 2003 would have made money equivalent to a tech stock or a Bitcoin. The money just multiplied by 10 times. So hard assets come into play because there is no space left for the money to flow into financial assets. It starts flowing into hard assets. And that's why, people are getting more bullish on harder assets like commodity, real estate. It's not because of the cycles, there's a fundamental change in the cycle, but because there's so much of liquidity around. And obviously there are supply side concerns also in commodities. So in this case, what happens with gold is that and obviously when the inflation goes high, it corrodes the value of the currency. For instance, if India has a higher inflation than US, then the net value of Indian rupee will depreciate a lot faster vis-a-vis some country as a currency which has got inflation which is equal to the inflation in the US. So then gold becomes not only a hedge against inflation as a hard asset, but also an inflation against currency depreciation. So that is why it is preferred not only by retail investors, but also by institutions. So it gives you a double hedge against that. But again, it's not a linear equation. It's not X is equal to Y. The inflation has to surprise on the upside or the downside, and it has to be a lot stickier than what people are building in their models. Only then and then you'll see a very significant move in gold on the upside.
Right. Very lastly, Vikram, what kind of returns should investors expect from gold then in the long term?
So, well, whilst we don't have a mandate to give calls on any asset classes, but I think historically, if you see gold returns, if you talk specifically about India and the emerging markets, historic returns on gold in the past 50 years have been somewhere between the returns of equities and bonds. Right. I think, again, as I say that in our business, past returns are not guarantee for the future performance. But I think that will continue for the simple reason that, if you look beyond this pandemic and the economic cycles, what the new environmental and new technological disruptions are doing, they are creating demand for, commodities which were very unloved. Lithium, nobody used to discuss lithium 10 years back, but because of electric vehicles, silver is going to be something which will be powering the solar and gold also, because as the cost of the gadgets go up, gold, they've got superconductivity and properties, silver, gold, much better than copper and steel. So you will see and ESG. Now, most of the gold mining is very polluting. For getting 1 gram of gold, you have to mine probably a ton or 2 tons of gold. So that's the kind of consistency you get on gold. The ores are very, very, and typically the average depth of a mine across the world, gold mine across the world, is about 2 to 3 kilometers. So we are already, we have exhausted all the open cast and the open pit mining. So the costs are going up, and if the environmental, if the ESG thing becomes big, then not only gold, but all the mining industries' costs will go up, and it will be very difficult to start greenfield projects, to get the funding for that. And also, if you look beyond the economic cycle, if you look beyond this pandemic, then few years or maybe half a decade ahead, you're looking at a very big question mark in lots of commodities, especially metals, base metals and precious metals, where the demand will continue and in fact may accelerate in certain cases. But there is a question mark on the production with regards to environment, with regards to funding, with regards to technological disruptions. So yes, so if you really want to take a very long-term view, you should be looking at the hard assets.
Right. Thanks, Vikram. Thank you for helping our viewers understand the significance of the yellow metal and, of course, the returns one can expect from this asset class. Season greetings. Happy Diwali. Have a very prosperous year ahead. Thank you, Vikram.
Thank you very much, and happy Diwali to you and your team.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.